Hey, good morning, everyone. Marty Missouri here. It's Wednesday, the 7th of June, 2023, with your midweek stock market snapshot. We'll just take a quick look at the S&P 500, the NASDAQ, and I do want to look at the VIX as well. But before we jump into the charts, just to kind of talk again about what we're seeing in the data, what we're hearing in the commentary, and so on. We scored our equity market conditions index, do that once a month at the end of each month, and touched on that in yesterday morning's written blog post. Still a minus 50, which is really minus, so to speak, meaning conditions are not conducive to taking on a lot of risk right here, equity market risk. And that's despite what we're really beginning to hear a lot from the masses, if you will. Listening to Bloomberg this morning, as I intimated in yesterday's written blog post, and it shows up in our sentiment index, that the bears are starting to capitulate a bit. They're starting to move over to the bulls' side of the boat, so to speak. And I get it. It's been very painful, I think, certainly for global macro hedge funds who, as of last Friday, as a group, were still underwater on the year. As I've talked about here, I think on the videos, that's career risk right there. So if the data is going to continue to get better, or if it's going to hold up, I can't say it's continuing to get better. In fact, it's been kind of doing the opposite of late. But if it's going to hold up and AI is going to change the world, and if inflation indeed is going to come down and the Fed is going to ease off and we're not going to get that recession, then bear market over, new bull market has already begun, and we need to get on that bandwagon or we're really going to be left behind. As I stated, I think in Monday's blog or another blog over the last week, that absolutely, if we do not have recession, our original 3,500 bear market bottom call, which we called before our indicators were flashing recession, that holds. And the next bull market is on. The problem is the preponderance or the balance of the data and the information and everything that we parse still says the risk is unusually high. And the analogy I gave to a client this week who likes to hike a lot, I said, just kind of think of it this way. You've scheduled your ideal backpacking trip for a week, and it's coming on that date that you put on the calendar, you took the time off and everything, and we're getting real close. And suddenly we get a change in weather, and you look at the forecast, and now the forecast says that while you're on your trip, halfway through, about 2/3 up the mountain, there's a 50% chance of one heck of a blizzard. In fact, it could be the kind of blizzard that if you're caught in it, you might not make it back down the mountain. Now, again, there's a 50% chance that you'll have the time of your life as well. So we have to think about that. Now, you've hired me as your guide to take you up that hill. And I look at the weather forecast and I consider what's at stake. And I apologize profusely and I say, listen, I have to cancel our hike. I'm sorry. And I know you're looking at people traipsing up that hill right now as we speak. In fact, there's quite the crowd heading up the hill right now. And I'm telling you that it's not safe to go and we really shouldn't go there. So you could fire me, of course, and you could hire one of these other guides, and I certainly would understand. But if you stick with me, we're gonna hike around the foothills, lower elevations. We'll pick some daisies. Sure, we'll get the flash flood if that blizzard happens up there, and we'll get caught in it, and it'll take us down a foothill a ways. But we can recover from that pretty easily, and we've got some life preservers on and so forth. So I'm just not willing to risk your life, frankly, taking up that hill. And by the way, it doesn't mean that I know the blizzard's coming. It just means that I know the risk is there. It may not happen. The sun may shine the whole trip. We may look back and say, geez, we would have had a good time. But that doesn't mean it was a smart hike to take. If a lot's at stake, you just don't go hiking way up to a high elevation when there's a 50% chance of a life-threatening blizzard, right? And I'm not saying there's a 50% chance of recession. I actually think it's a little higher than that. And I do think that a recession is going to be hugely problematic for the stock market if it happens. So keep in mind, folks, when I express our view at PWA, I want you to know we are not bears innately. That's not our DNA. It really isn't. We've been bullish throughout, I certainly have been throughout most of my 38-year career. What we've learned over the years, though, is to try not to be either emotionally, right? Either bullish or bearish. Always check yourself. Always make sure it's not some underlying personality trait or some personal bias that has you seeing risk around every bush, for example, or seeing sunshine in every corner. I listened to a bull this morning on Bloomberg who just expressed with passion everything that's potentially good about the future and left no option for anything bad to happen. And that's just not good commentary, in my view. Just like it's not good commentary for the bears to just talk about everything that's horrible and not consider that, hey, we could have a productivity wave that could begin right now, that could ultimately pull us out of this, for one example. We have to consider those things and we have to look at those. In fact, I read an excellent paper, I'm going to read it again today, that pointed out the 4 possibilities for the future, the 4 realistic theses about how this could go for the U.S. economy and the U.S. markets over the next 10 years. And I'll probably comment on some of that and share some quotes from that, but I thought it was just perfectly done, meaning they looked at both sides, considered the probabilities or the possibilities, and really parsed it in real world trends, data, so on and so forth. And there's a real optimistic scenario in there that is worth considering and worth gauging the probabilities of. So we need to do all that to do this right. One of the things I want to just kind of close this monologue on is that view of sentiment and bulls coming off the sidelines. Investors Intelligence, we pay them for some of their work, specifically their sentiment indicators. So they're polling advisors, newsletter writers on markets. And this is a really good sentiment indicator. It's one of, I think we have 8 or 10 in our own metric. Anyway, so the bulls this last week topped 51.3%, and that's up from 47.9 a week ago. That exceeds their mid-April peak of 50.7, and it's the most bulls since November of 2021. That reflects funds moving to equities and becomes a concern as it nears 55%. So that's what I'm talking about. The more bullishness that shows up, the more bearish the ultimate setup can be. And then the bull-bear spread jumped to 29.7 versus 24.6 a week ago. That's the largest difference, positive difference of the last 29 weeks, and it's very near a warning signal. A spread above 30% is the first sign of elevated risk, and it goes on. That's what I've been intimating here the last week or so is, I'm seeing that move, and that opens the door. The less bearishness there is out there, for example, the lower the put exposure for the market. And remember, when somebody buys a put on the S&P, for example, there's a dealer who shorts the S&P to hedge their downside risk because they lose if the market goes down. And then when that put expires or it gets sold or what have you, that short hedge that the dealer does has to get covered. So there's always that buying under the surface and that's just one example that shows up in the options. And then, of course, if people are just outright short and there's still kind of a multi-year net short interest in the S&P among speculators, those are shorts on futures that ultimately need to be bought. So that's still in there. So that's that bearishness. So you know that there's buying that's going to happen at some point. Now, as we get bullish and suddenly everybody's loading up on calls, well, guess what? The dealers then have to buy the underlying in some form to hedge the upside risk because they lose money if the market goes up. Ultimately, that's some selling that comes in. So there's always kind of this dance between if we get too far on one side, the actual support for the market is opposite of what those people think it is, right? So that there's been a lot of support because a lot of people, I think rightfully so, came in bearish at the beginning of the year. Well, that bearishness is beginning to wane. And that, again, just kind of, as I said yesterday, it thins the support for the market underneath. I'm not saying the market's going to come crashing down tomorrow. If you read the blog yesterday, I said the next couple of months, I think people might be constructive. The Fed's not going to raise in June in all likelihood. I think inflation's going to come down on a year-over-year basis because of favorable base effects. I understand where this bullishness is coming from. And I think people are seeing that and they're thinking, hey, that we're in for a good run. Well, if they start believing it and they start acting on it, then suddenly the risk begins to get greater. The support, I should say, for the market begins to wane underneath. So anyway, folks, there's so many angles that we can approach this from. The key is always objectivity. So in front of you is just the daily chart of the S&P 500, and we'll keep it quick and stick with this. So we've got a new high right in there, at least relative to where we've been all the way since last August, right? We are wedging up there though, and we are bumping right against the 61.8% key Fibonacci retracement level. So that means we've retraced 2/3 of the bear market so far. So this is either a bear market rally or it's a new bull market. The reason this is highlighted is because these are real technical significance. These tend to be areas of retracement where the market fails. So if the bear market's still on, this is a key level that actually you could see something happen from here. In terms of the momentum indicators, again, you've got this going on up here against still, I think, very long and extended bearish divergences on the MACD and the RSI. So not a good technical setup. If you trade this way, you would wait for a break below the uptrend line. I would probably wait for it in this channel right here if I wanted to aggressively short this market. And I'd look for a breakdown below this support, this other blue line right here. And I'm not giving advice to traders, by the way, but just kind of thinking out loud. The NASDAQ 100 index, as we pointed out, the big rally that we've seen burned through this shorter term bearish divergence here this last week. So that negates that negative signal. Very overbought right here, folks. And that's been a dangerous level for the RSI throughout this bear market. So that, along with the rising wedge, makes it a little bit precarious looking. And also, I noticed earlier that you really still have a divergence, a very long-term one, when we go all the way back here to last August as well on the MACD. So really heavy looking for the NASDAQ 100. This is the ETF that tracks that. Just bursted right through that 50% retracement and butting up against the 61.8. We could go higher. We could test last year's all-time high or 2021's all-time high. Yeah, I think if indeed this does break, folks, it could be swift and it could be quite startling, particularly now that we've got people moving over to the bull side of the boat. And then lastly, really quick, just want to look at the VIX. Remarkable how low it is. As I speak at you right now, the VIX is 1405. It actually dipped below 14 this morning. Absolutely remarkable relative to all that's going on out there, and it just speaks to what's going on in the options space. So, but when I look at it technically, we have a really beginning of a really bullish looking chart. We've got our falling wedge, right? And we've got very definite bullish divergences on our momentum indicators. So folks, we've done this over and over and over again, and you know how reliable these patterns can be. They're not perfect, they're not 100%, but I mean, you see the big topping out here, and you notice we were pointing to bearish divergence. Here we were falling right into this falling wedge pattern, and here we had bullish divergences, right? Well, that's what we're looking at here, headed here and so on, right? And here we actually had, surprised I didn't draw this, here we had just a perfect almost bull flag pattern, right? And so that played out to a T, right? Then it rolled over and so on. So VIX looks ripe for a bounce here. Again, for it to be something technically sustainable, you have to break through that downtrend with momentum, but it looks like the setup is kind of coiling for that to happen, and that would lead to a fall off in stock prices as well. But like I said in yesterday's written note, folks, these things can take a while if indeed they're actually going to happen in the foreseeable future. Again, you can make a case based on what I said a minute ago. Next couple of months may be okay, but you notice there's just not a lot happening right now. We have a blackout period for the Fed. They can't talk until next week. I think it's a week from today. In fact, I'm sure it is the 14th when they're going to give their policy decision. And, that makes sense. I guess the volatility would come down in front of that and the market would just kind of meander around, which seems to be what's happening right now. So folks, I'm going to need to just do a hard stop right there. Hope you have a good rest of the day. We'll be back later in the week on the video with a end of week snapshot and of course the economic update. This is a light week in terms of data, but developments around the edges that I think are going to be worth talking about over the weekend. Thanks as always for watching and listening. Talk to you soon. Bye-bye.